Hello and welcome to Seven. And I'm your principal, Matthew Mills, and I know you know what I look like. I haven't changed much since this photograph was taken, but I am now sporting a natty little beard. So, with no expense being spared whatsoever, we've used cutting edge technology to show you what that might look like in the flesh. And in this lecture, we're going to have a look at the new and improved Seven investment proposition. Now, investment management is a fundamental and critical component of the financial planning process, getting you from your stated goals to actually meeting your objectives in the long run. And really, it's the engine room of financial planning driving the whole process. Now, we've got a fairly extensive document that articulates this in great detail. It's part of our About Seven documentation. And this particular document is called Our Investment Management Process, a copy of which is downloaded to you when you sign up and are registered for your Seven Wealth account. Now, another slightly shorter document you might want to have a look at, which is actually integrated into the Fuller Managing Your Investments document, talks about our investment partners, and it specifically focuses on the companies and services we use and outsource to help manage your money. So why did the proposition need to be broadened? Well, first and foremost, we are in a very dynamic economic situation, where the landscape is changing quickly, and we need to be nimble. We also need to broaden our proposition to meet the range of preferences and needs that our clients might have, specifically also to accommodate orientation to sustainability, which is now becoming a regulated activity that we are obliged to undertake. On top of that is to build resilience so that we're not dependent on one single fund manager. That also our money is more diversified because no one's got a monopoly on good ideas, which contributes to service continuity and resilience in the practice as a whole, just in case anything should happen to yours truly, heaven forbid. And finally, is to support service continuity and succession in the long run, because unfortunately, the beard that I showed you at the beginning is not black, it's very grey, and there will come a point where I won't be able to do this anymore, and we're going to need to find someone that we can all rely upon who can. So when we embark on a search to go and find our investment partners, there are a number of things we have on our shopping list. The first one is co-alignment with our core values, which is around transparency, authenticity. Then also a completely defined investment process so that when I look at track record and performance, which is further down this list, I can see how a manager has done it and how it's likely to do it again. We also want our managers to have independent ability to select assets and funds that are going to build into their portfolios. We want completely transparent fee reporting, which then allows us to assess the value of a proposition, clear reporting, and excellent service support each other. And then behind all of that is we obviously want to be investing in reputable companies with financial strength, which offers us stability and service continuity in the longer term. To support the broadest range of preferences and needs amongst clients, we also have a number of other things on our shopping list when we're looking at managers. And we'd like at least one offering a high conviction concentrated portfolio, very similar to the Seven portfolios. We'd also like a manager that offers active risk management and downside protection, part of which can be offered through access to alternative assets. And we've seen that over the last year where traditional correlations that would protect a portfolio have broken down, and this is a way to deal with that. As I mentioned earlier, we now are obliged to consider ethical considerations, and we need managers that would deal with that. Equally, while most clients that we work with favour and value active management of their money, sometimes we might have clients who want a more passive approach, or there might be some advantages in some circumstances to blending the two approaches. We can access a market where you can't add a great deal of value through active management, and it can reduce costs. We also want a highly simplified and low-cost solution for those clients who are not rich yet, for example, but are not necessarily paying a great deal of attention to their investments. And then finally, some of our solutions, and this is more about venture capital trusts, which we'll get into in another presentation. We might want a manager that can offer tax mitigation alongside the other must-haves. One of the cornerstones of our practice, and stated actually in our terms of business, is to leverage the collective strength of the entire client bank for the benefit of everyone else. And the management of the underlying investments is no different. And no matter what anyone has told you, size does matter because institutions have greater buying power because the size and sums of money that they look after. That means they can negotiate better deals and affect downward pressure on costs. In addition to that, certain alternative asset markets, timber, for example, being one, is something that retail investors often can't access as effectively because the minimum criteria for buying into one might be more than we collectively have. In addition to that, large institutional investors offer greater solvency and security for us. And by spreading money into a broader range of assets and funds, it improves diversification and the resilience of the portfolio, your strategy, and the practice as a whole. So using our shopping list, we've whittled down the number of potential suitors to a manageable number. There are then a number of deal breakers to decide whether we're going to integrate them into our strategy or not. First one is just objective performance. So what results have they delivered in pounds, shillings, and pence? Then we're going to have a look at a quantitative assessment, a statistical assessment, if you will, of that performance to see is that simple dude our luck, or is it something that they've actually done that is statistically meaningful? We can have a long conversation about information ratios and Sharpe ratios if you'd like to do so. The next thing is a qualitative assessment. So do we like these people? Do they fit our core values? Do they then have a process they can demonstrate to us to show us how they're going to deliver these results again in the future? Now, a next point is objective performance is great, but if we're paying 100 basis points to get 10 basis points, that's not growth at a reasonable price. So we're not specifically just looking at cost, we're looking at the value of a proposition. Finally, is measured risk and security. So a clear structure that shows us the risk that a manager is going to take with our money and the size of the downside we might encounter. And then finally is any provider that we might look, there must be no ties whatsoever, no exit penalties whatsoever. They are basically on a one-day contract. Any day we don't like them, any day we find somebody better, we must be able to get out immediately.
So, selected from the whole of the marketplace, our core investment proposition is really based on outsourcing to four managed portfolio services. And these are looked after for us by Canaccord, Quilterworth Select, Vanguard Life Strategy, and W1M, formerly known as Waverton. Now, for the vast majority of clients, one or more of these managed portfolio services will suffice to look after their money and will meet most people's needs. However, every now and again, you may have very, very specific objectives, and we might need to do something bespoke where we'll build something for you selected from the entire universe of funds and build it for you personally. Quite rare, but we have that facility if you need it. Also, outside of that, we engage with Octopus Investments. They're a specialist investment manager, mainly for venture capital trusts, which can add additional tax and asset diversification to a portfolio. Now, when we're selecting our investment partners, we're mindful that we want each of them to bring something a little bit different to the table. Now, Canaccord Wealth, for example, they are the wealth management arm of a global investment bank. They provide us with an actively managed proposition where they're actively picking positions, but specifically, they offer portfolios based upon high conviction or concentrated portfolios. What that means is they tend to take larger positions in particular ideas and themes and sectors where they feel they're going to get better returns. Linked to that, they also give us dynamic risk management. What that means is effectively they're keeping an eye on things and they're going to be adjusting their holdings on a daily basis. They're also fairly sizable. In total, they look after £36 billion worth of client money, and they actively employ that scale to leverage costs on the assets they buy, which is passed on to clients and is wholly in line with our modus operandi at Seven. And if you'd like to know more, here is their web address, and you can click on that and go and have a look. Now, W1M are slightly different. They are a specialist in high net worth. looking after high net worth individuals, families, and charities. They're based in the City of London. They also offer an actively managed proposition, but whereas Canaccord will go and buy investment funds to put together their portfolios, WNM do that through direct investment into securities. They actually manage four individual mandates, which invest in fixed interest, stocks and shares, um, uh, alternatives, and also real estate. They blend those into six different portfolios, but each one of those mandates will be invested directly into securities. So, for example, the equities portfolio will actually go and buy stocks and shares directly, which is very different to Canaccord. Another thing that's very different is built into their portfolios is some downside protection. So, if markets dip significantly, then there's some protection against that. It's not absolute, but there is some protection. And they look after a fairly sizable amount of money as well for clients, around 21 billion the time we're putting this together. And if you'd like to know more, there's their web address. Then we come on to Quilter Wealth Select, and this is the investment proposition which is available to us through our preferred investment platform, Quilter. It's a discretionary fund manager, and the thing that they give us is a huge range of choice. So if you wanted a passive index tracking investment, if you wanted an active investment, or you wanted a blend of both, they have something for everyone. They also have specifically sustainable and environmentally responsible options, which are dedicated to that, as well as being built into all of their portfolios. Now, once again, they leverage their economies of scale with the underlying funds and managers they work with to drive those costs down, and that gets passed on to us. But most of their portfolios, not all of them, but most of them also have capped costs and can't go above a certain level. Quid worth select again, fairly sizable. Now look after about 20 billion quid worth of client money. And they also have the longest of the web addresses of any of our investment partners. So they get a prize for that one as well. And then finally, there's Vanguard. Now, Vanguard are part of an American parent. They're absolutely enormous. And you'll see here that they manage over 8 trillion dollars of client assets. So that's an order of magnitude of all the other three put together. So absolutely huge. Now they specifically focus on running client money through index tracking portfolios. That means that they are passive, but they are, as a company, dedicated to cost reduction through economies of scale and have consistently brought their prices down. And this is a particularly good option if active management is not your bag at all, but you are specifically into the cost effectiveness of your investments. And once again, here's bringing the scale down on the web addresses again. You can have a look at them through their web address here as well. So that's our core investment proposition. Those are the core providers we use, and that's how we selected them, which leaves the remaining question, how on earth do I use this proposition to manage my own money? And I'm glad you asked. So first thing we do is we'll ask you some questions about your orientation to sustainability, or ESG, ethical sustainability and governance issues. And by way of example, if you look in the bottom right of this slide, we've got an individual here who is ESG dedicated, which means that they want to make that the priority for managing their money over growth. And specifically for that, Quilter Wealth Select operate a sustainable, a responsible MPS, which is specifically dedicated to that. It's the only one of the managers who provides a portfolio specifically focused on sustainability over growth. So 100% of the money would tend to go in there. Alternatively, we have clients on the opposite extreme. That's on the left of this example at the bottom, where someone could be ESG aware, so they know what it is, but it's not a priority for them, and they're focused on growth. In which case, our suggestion there would be probably to use two, ideally three of the MPS providers and to run them in parallel. And the reason you do that is because running them in parallel, you get something called internal matriculation in your portfolio, which basically is a very fancy way of saying that it becomes really obvious if someone's going off the boil compared to the other two. So it gives you a bit of comparison as you're going along. Um, So that's ESG. The next thing we do is we'll ask you about your attitude to risk, which is basically your tolerance for volatility and seeing your money going up and down. Um, and on that basis, we'll identify an ideal asset allocation for you, which will moderate your attitude to risk, but be appropriate for your objectives as well. Um, and select a range of portfolios on that basis for you. Um, Now you'll also see at the bottom in the middle, there's somebody called ESG focused. And this is for someone who wants to take ESG and sustainability into account, but they don't particularly want to make it the priority for the portfolio. And the good news is that all of the providers that we've selected all have an inherent structure for taking ESG into account in their selection for the underlying investments. So um, if you're dedicated, we have a limited range of choice for you there. But even if you're aware, then ESG is being taken into account in your portfolio.
And there we go. That brings us to the end of this lecture about the investment integration. But what have we learned? Well, what we've learned is that the 7 investment proposition has been designed to improve our responsiveness and our resilience while offering greater choice and support service continuity to clients in what is a dynamic and shifting economic landscape. We've got 5 managed portfolio providers which have been carefully selected from the whole of the market, and I've explained how we've gone through that process. This has been designed to accommodate the broadest range of needs and preferences, and in that we include the new mandatory requirement for us to assess one's orientation to sustainability and to include that in the design of any investments. Equally, these are mandates and companies co-aligned with our own core values, and specifically also supporting the leverage and cost for economies of scale that has always been a central plank of our practice. Now, no presentation in financial services would be replete without a disclaimer, and there are actually 2 here. So here's the first one. You've heard this one before, which is that the value of investments can go down as well as up. Now, I know you know that, but it is important really to restate it, is there are no guarantees, just like most things in life. And having got that disclaimer out of the way, here's another one. And this is really just to say that this video is intended to inform, to educate, and to entertain. It doesn't constitute advice. And as I said on the penultimate slide, any conversation about the structure of your investments, the solutions you might use, we will have with you on a one-to-one basis. Now, that's it for this time. I hope that was informative. I hope that was entertaining. And I hope that was educating for you, in which case we've met our primary targets. And on that note, I'll see you next time.